So, oops. Basically, remember in the 2100, right? You learned about the obligation only happened after the declaration. If you do not declare dividend, you have no obligation to pay dividend. Remember that? Okay. So
Yes.
before this declaration, there's no obligation of paying dividend, right? But after the date of the dividend declaration, you are obligated to pay the dividend. So the question is here, how are we going to deal with this for the reporting period ended December 31st, 2021? So we are talking about this reporting period. How are we going to deal with this event? Any ideas? Recognize it? Should we recognize it?
Yeah, it'd be
Yes.
recognized.
Recognizing the notes.
I'd say it'd be recognized in the fiscal period that just is over.
Okay, I heard people saying recognize it in the notes, right?
Yes.
That's right. Yeah, you want to how about you recognize it on the report? Is this a liability?
It is a liability, but it occurred after the cutoff period. So that's why it should be reported in the notes.
Yes, remember the recognition, right, is only up to cutoff date.
Mm-hmm.
Remember that? So if you want to recognize this to be a liability, right, it has to be a liability on the cutoff date, right? But on the cutoff date, there is no obligation, right? There's no obligation. So it's not a liability, right?
So does that mean like when the next fiscal period starts, there'd be a note saying that dividend payable, and that's where you would take action to pay the dividends?
Yeah, so in the next period, you're going to recognize this liability, right? Okay. In January, if you declared it, then you have to enter this dividend payable. And then when the dividend was paid, you're going to revert, you're going to settle that dividend payable, right? So the point is here, on December 31st, 2021, there is no obligation. So you cannot recognize the liability. The key point here is for recognition purpose, remember? For recognition, you only recognize up to cutoff date. So on December 31st, 2021, there's no obligation, right? So there, you should not recognize the liability there. But this information is important. You want to include it in the note disclosure. So, oops. So no financial statement adjustment, but you need to disclose this information in the notes. Okay?
Professor.
Yes.
Yeah, that seems like till the cutoff period, like there is no transaction, right?
Yeah, there's no transactions for the reporting period. Yes.
Yeah, after cutoff, we have transaction is like the information already listed.
Yeah.
Okay.
Okay.
So to clarify,
yeah.
Sorry, there's no math behind it. It's just basically written in the notes, just as a formality.
Yeah. So because the signature happened here, right? This is where the signature happened, right?
Yeah.
So you're basically saying, you know, on this date, there is $80,000 dividend declared.
Mm-hmm.
Yeah.
Yep.
Okay.
Sorry to interrupt, but what if it's like right on the cutoff, like say December 31st?
Oh yeah, then you need to recognize that
Yeah, so they like made it. Yeah, so they declared it and then they paid it after. Then
yeah, because you declared it on the cutoff date, right? So then it's a dividend payable on the cutoff date. So you had to make a financial statement adjustment, right? This is a dividend payable. Okay, so interesting. Let's take a look at another scenario. The Supreme Court of Canada finds Fundy liable for breach of contract and awards the plaintiff of $153,698 in damages. Fundy had previously disclosed the lawsuit in its financial statement, but has not recognized the provision. Okay, so this is what happened. Draw a timeline will help you, right? So it's a court decision during the subsequent event period. Okay. Now, I want you to think about this. The liability, okay? On the cutoff date, is there a liability you should recognize?
No.
Yes.
Yes.
I would say yes.
Yeah, because the Fundy had previously disclosed a lawsuit, right? So this lawsuit has been there for a long time, probably. Okay, so the potential liability happened here, right? Happened here. But why they didn't recognize, measure the number? So you know how much you are liable, right? They didn't put a number. Instead, they disclosed it in the notes, right? Why they didn't put a number previously?
Because it was still in courts?
Yeah, because there's uncertainty. They don't know how much they're liable for. They are probably guilty. They thought, well, you know, we probably have to pay some money, but we don't know how much we're going to pay, right? If I don't know how much I'm going to pay, how am I going to put a number there, right? Therefore, to my best knowledge, I'm just going to disclose this information. Okay, now for this year, what are you going to do?
Professor, I'm just a little bit confused around here, the statement. The statement is like listed like, there is, there is not recognized, like, you know, the provision, like, the figure amount, like, but whatever the superstore of the, whatever the company is liable for that numbers, but it's not recognized yet. And then what we have to like record till cut off.
So the cutoff date is December 31st of 2021, right? So in last year, December 31st of 2020, the case is there, but there's the uncertainties. They don't know about the amount of liability, okay? So they cannot put a number there, recognize it on the statement of financial position. Instead, they just disclose this information in the notes, okay? Because there's uncertainties. So for this year, okay, the court decision settled the uncertainty, right? Now they know they are liable for this number. What do we need to do here for measurement?
You make adjustments to the financial to add the numbers?
Yes, because the measurement, for measurement purpose, you have to take information up to this signature date, right? And you know already the liability is this number, so you have to do a financial statement adjustment to recognize liability, right? Because this is about measurement, right? Before you don't know the value. Now you know the value. You have this information. You can measure it. So you have to make an adjustment. So you have to do a financial adjustment here on the court decision date to the reporting period ended December 31st, 2021. Okay, let's do one more. We'll come back if you're still confused, okay? Let's do one more here. Fundy issued $500,000 worth of shares for cash, okay? So here is that timeline. Here is the common share issuance. What are you going to do with this?
You have to disclose.
Disclose?
Yes,
Very
disclose.
good, very good. So no financial statement adjustment, right? No financial, because the transaction happened after the cutoff date, right?
Yes, that's right. Yes.
Yeah, okay.
So,
Yeah, but this is important information you want to disclose, right? You want to disclose.
I have a question.
Yes, please.
So I just want to be sure I got the difference correctly. So are you saying that if the information was known before the cutoff date, then we must report it in the in the statements, right? And we can use any information that is available to measure up until the subsequent period. Is it subsequent event period?
Yes. So you can use all the information, even the information during the subsequent event period for measurement purpose. For measurement purpose. Yeah.
But if the information, if we need, let's say that the information became available after the cutoff period, then we only need to disclose it in the notes. Am I right?
If it's not measurable.
Yeah, if no. So in this case, if the court decision happened after the signature day, right? So that means you don't have this information during the subsequent period. You have to keep disclosing this information, because up to the signature date, you still don't know what is the amount of liability. So you can only disclose this case, right? You cannot measure it because you don't have that information, right? So if the court decision happened here after the signature date, you can only disclose it, right? You cannot.
Perfect.
Yeah, you cannot measure it because you don't have that information.
All right, thank you so much.
Yeah, so the key point here is even the information happened during a subsequent event for measurement purpose, okay? Not for recognition purpose. For measurement purpose, you can still use this information to measure, okay? Make sense?
Yes, thanks.
Okay, but for recognition purpose, the cutoff date is here. The cutoff date is December 2021, okay, for recognition purpose. So if there's another legal suit, another lawsuit happened here, would you recognize it? If
no.
it's a new event.
No, disclose only.
Yeah, you only disclose it, right? You don't recognize it, right? Because it's not happened before the cutoff date, right?
Yeah.
Okay. So this is the subsequent event. Now we are going to talk about accounting changes, okay? Accounting changes. So sometimes managers will make changes in accounting policies, right? They used FIFO before, now they decide to use moving average, okay? So that's called a change in accounting policy. So this change in accounting policy is basically at the discretion of the manager. The manager decide, I think I'm just gonna do moving average because I don't like FIFO anymore, okay? So if the decision is purely because manager's discretion, then it's called a change in accounting policy. However, it could be new information came and the accounting changes has to be made. For example, the tourism industry, right? Previously, maybe the bad debt rate is 1%, right? But because COVID or whatever, the bad debt rate will be 2%, right? 3%. The bad debt rate will be higher, right? Because of certain negative events. So this is a new information, right? So manager has to say, previously when everything is okay prior to COVID, the 1% really reflects the default rate. But now because of COVID, people are affected. So the default rate will go up. So I have to change my default rate from 1% to 3%. This is because of new information, right? The market gave a new information to the manager, and the manager has to react to the new information to make the change. So this change is because a new information. So that's why we call it change in estimate, okay? A change in estimate. If this information is not new, they made an error before, right? So then it's called correction of error. So basically this graph tells us, is this change due to new information? If you say yes, and then you would ask, is this information known in the prior period? If you say yes, and then you made the mistakes, right? This information was not new, actually. It's just because you didn't realize this. You made the mistakes. So that's called the correction of error, okay? But if it's new information that was not exist in the prior period, it's a new information in this period, then it's a change in estimate, okay? If the change is due to manager's discretion, it's called a change in accounting policy. Did I make the three types of change clear?
Yes.
Yeah? Okay. So now let's test if you really understand this. Okay. If the correction of error, if the number was incorrect, so then you have to go back to the prior period to fix it, right? If in the previous period the information is there but you made a mistake, you have to fix it. So this is the retrospective adjustment. You have to go back to the prior year to fix it. That's pretty straightforward, right? You made the mistakes in the prior period. You are correcting that error. You have to go back to the prior period to fix it, right? So retrospective adjustment. For changes in accounting policy, in the prior year, your inventory cost, the ending inventory was calculated based on FIFO. In this year, you decide to use moving average. So you better to go back to the prior year to recalculate the ending inventory using moving average, right? Because the previous number is calculated based on FIFO. And now you are saying you are using a different accounting policy, then you have to make sure the policy is consistent over the time. So you have to go back to the previous years to recalculate the ending inventory using the new policy, which is the moving average. Why should I do that? Why should I make a consistent accounting policy?
For comparability.
Thank you. Oh, wow, chapter 2. Yes, thank you very much. You got it. Yeah. So for comparability, right, within the firm over years, right? If you use different accounting policies, you cannot compare the numbers, right? Okay. So if it's accounting, yes.
I have a question. So you said it applies to all the years affected. So like how many years will that be? Is it like 10, 15 years or 5 years or how many years?
Yes, it has to go back to the year when you started using the policy, inventory policy.
Okay.
Yeah.
So even if it's like 20 years ago, you have to go back 20 years.
Yeah, all the years, right? Because every year has ending inventory. And that ending inventory is the beginning inventory of the next year, right? So you can see that if the first year's ending inventory is a different number, it's gonna carry it on to all the future years, right?
I'm sorry.
Sorry, I have a question here.
Okay, who am I speaking?
Yeah, Tim.
Okay, Tim.
Yeah, so I'm just wondering, let's say like a manager decided to use weighted average this year, starting this year instead of FIFO, then why would you have like retrospective? Like I don't understand. Like if I'm using weighted average this year and from now on I'm using weighted average, then why would you still be using FIFO accounting this year? And then you have to come back next year to fix this. Like, wouldn't you make the decision first to change the inventory accounting, and then you would change the calculation already?
Very good.
Like, why would you? Yeah.
Yeah, because people change their minds, right? Over the time, people, decide to make changes. They don't like the policy anymore, or for whatever reason, they decided to change the policy. And you can see there's a lot of work, right? They have to evaluate the cost and the benefit. Is this really worthy for me to go back to all these years to change all these inventory numbers? That's going to affect my accounting information, my earnings, right? Is that really worthy of it? Right? Ideally, you don't want to get into that situation, but it does happen in the real world. Yeah.
But I mean, like, wouldn't the accounting be forward? Because, like, like let's say last year you were using FIFO, and then this year you start to use weighted average.
Yeah.
Then starting this year you would use weighted average as the accounting policy, right? Then like when would you have a time that you would go back to change?
Yeah, because when you present this year's financial information, remember we have a comparative figures. So in the financial statement, you would see this year's 2020. They are not only presenting 2020's information, they also have a comparative figures for the previous year, right?
Okay.
So then you can compare, right? Because the inventory numbers are calculated differently using different method. So you cannot compare that two numbers.
Okay.
Right? Because if your inventory number was calculated using moving average in the prior year, it's going to be a different number, right?
Okay.
So you have to use a consistent accounting policy, because otherwise your information characteristics, especially comparability, will be on threat. You cannot compare current year versus the previous year, right?
Okay, so that depends like how many years of information you're presenting. So you have to go back to how many years.
If you want to get the last year's number right, you have to go back to the beginning, to the first year, right?
Mm-hmm.
Because the first year's number is going to be carried on. For inventory, the first year's number is going to be carried on, right? The first year's ending inventory is the beginning inventory of the second year, right? And then the ending inventory of second year become the beginning inventory of third year, right? So it's always carried on, right? So if you really want to fix the ending inventory of the prior year, you have to go back all the year to the very beginning.
Okay.
Otherwise, your number won't be right, right? Yeah. So the idea is to make sure it's consistent. Your accounting policy should be consistent.
Okay.
Yeah.
Okay. All right. Thank you. Yeah.
No
That's clear now. Thanks.
Yeah. Okay. Anyone else have a question? Okay. So you got the idea, right? So these changes in accounting policy also be done retrospectively, right? The changes in accounting estimate, okay? This is because new information, therefore the adjustment is only prospective. So you are saying this year now, because the COVID now is 3%, right? So I have to go back to the previous year to make it 3%. That is wrong, because in previous year, there's no COVID. Whatever the number you use, 1%, 2% is accurate to reflecting the market circumstance of that year, right? This year it's 3% is because of new information, because of COVID, right? You should not go back to the previous years to make change. If you do that, you are wrong. Does that make sense?
Yeah.
So change in estimate due to new information that does not exist in the previous years is only affecting in the future years. You don't go back to the previous to make changes.
Sorry, just one question about that. Would, aside from changes in estimate, would there be any other scenarios where there'd be a prospective treatment?
There are.
Or it's just strictly.
This is the three changes, right? If it's changing estimate, you go forward.
Retrospective.
Correction of error or changing accounting policy, you have to go retrospective.
So that's the only three. There's nothing outside of that.
Yeah.
Okay.
In the next course, Management 3101, you are going to learn more about this, how to make adjustment. Yeah. Okay, let's see if you understand this. Okay, let's put into the practice here. Evaluate each of the following independent situations to determine the type of accounting change. Okay, the three types of accounting changes. The first one, a furniture maker decreased bad debt expenses from 3% to 2% of credit sales. Is this?
Change in accounting policy.
Changing in policy?
Yes.
Okay. What is the previous policy?
3%.
3%.
They were at 3% and then reduced it down to 2%.
the previous policy is the percentage of credit sales, right?
Yes.
What is the current year's accounting policy?
2%.
Percentage of credit sales, right?
Yeah.
You are not using allowance for doubtful accounts, right? You are not using the aged AR. Remember, there are two different policies to calculate bad debt expenses. One way is very easy. You use the percentage of the credit sales. That's very easy, right? The other way involved more calculations is the aged AR, right? So for different age group, you assign a different percentage, and then you calculate what's your allowance for the doubtful accounts should be, right? And then the difference between the 2 years is your bad debt. Remember that?
Yeah, so it's a change in estimate, right?
Okay, good. So tell me, the accounting policy is always a percentage of credit sales, right? But the estimate is changed from 3% to 2%. Maybe the economy is doing well. Their customers have money. They are able to pay. Therefore, the 3% is reduced to 2%. And you can see I even have the answer here. Change in estimate. Okay, let's take another example. Okay, so a manufacturer determines the credit losses are becoming material due to deteriorating economic situations. As a result, it decides to set up allowance for doubtful accounts at 5% of amounts all over 90 days. So they decide to set up allowance for doubtful account. For those amounts over 90 days, they apply the 5% rate here. Okay, tell me, which one?
Is change in estimate also? Should be
A change in estimate, exactly.
Okay, change in estimate, right?
Yeah.
Okay, so what is the percentage before?
Can you repeat the question?
Yeah, the question is, you are saying the change in estimate, right? So the number changed. Right now it's 5%. What is the previous number?
Would it be change in accounting
We don't
policy?
know.
Zero.
We don't know.
Yeah, it's
We
zero.
don't know the
right?
percentage.
The previous percentage is zero, right?
Set up.
Right? Because they didn't set it up, the allowance for doubtful accounts. So it's 0%, right?
Right.
Yeah. So yeah, this is a change in estimate because it changed from 0% to 5%. Okay. But is this also a change in policy?
Yes.
Yes, it would be.
Yes. Yeah? Yes. Because previously they don't have this allowance.
Yeah.
And now they put it on, right? So from absence to presence, this is a change in accounting policy, right? So in this case, it's actually both. It could be change in estimate and change in policy, right? If you think it's a change in estimate, it's from 0% to 5%. If it's change in policy, they don't have this policy before, but now they put this on this policy. Does this make sense?
Mm-hmm.
Yep.
Yeah, yes.
Okay, awesome. Let's take a look at another one. How we are doing with time, okay? Okay, C, a parking service estimates bad debts to be 10% of the value of parking violation issues. In the current year, it changes to estimate the allowance for that bad debts to be equal to 20% of accounts, 30 to 90 days, and 50% of the accounts over 90 days. What is this?
Change in estimate.
Change in estimate.
I hear both. So is this changing in policy or changing in estimate?
Oh,
Policy.
Both.
Okay, so I think
Change in estimate.
Okay.
I'm going to say estimate.
Change. Okay, so previously, how they estimate by that? 10% of the value of the parking violation issued, right? Mm-hmm. So they would say how much parking violation issued. They use 10%. That's how they do the bad debt, right?
Yeah.
They believe 10% of the issued parking violations will not be collectible, right? And now what they are doing, they set up this allowance, right? So they apply the 20% to the account outstanding between 30 to 90 days, and they set up 50% for those balance that
over 90 days.
90 days. Are these not the same policy?
It's a policy
No,
change.
it's not.
Policy
No,
change.
No,
right?
it's not.
It's a change in policy, right?
It's changed, yeah, both.
Huh?
No, it's a policy.
It's change in policy, right?
Mm.
If you are saying it's a change in estimate, what is going to happen is you're going to reduce the 10% to be 5%, okay? Then it's a change in estimate. They're going to increase the 10% to 15%. Then it's a change of estimate, right? So now they have a different way to do the calculation. This is a change of policy, right?
Yes.
Sorry, so for the previous example, where is both, like change in policy and change in estimate?
Yeah.
So you have to go both ways, like retrospective and prospective for this one?
Yeah, maybe I think it's just easier if you go just go for the prospective, right? You don't have too much work. Just consider that as a change in estimate.
Oh, okay, so you just need to pick one, right?
Yeah.
Okay.
Yeah.
Okay.
How are we doing with time? Okay, we still have 6 more minutes. So you can see that we learned about all these subsequent events, right? We learned about accounting changes, right? So these are very interesting things you didn't learn in the intro level accounting. Okay, it's gonna be more fun, right? As you learn more. If you are not comfortable, make sure you read your textbook, right? Make sure you read your textbook, and feel free to send me email, ask me questions. Okay, so let's move on. So make sure you understand, right? Under all these 3 scenarios, what are the how you're gonna make a judgment, which groups that changes belong to, okay? Okay, so now let's talk about these connections among the 4 financial statements. If you remember, the way how we teach the 2100 is we started from income statement, okay? And that number, the income number, goes into the statement of changes in equity, right? And then this number goes into the equity section of the statement of financial position. And there's a cash balance for the assets. And then the changes in asset in the cash will be explained by the cash flow statements, right? So this is how these 4 financial statements are connected, right? They are not standalone. They are kind of affecting each other, okay?